The world's most powerful oil cartel just fractured, the Middle East is blocked, and gold is sprinting towards $6,000 an ounce. If you think the AI tech boom is going to save your portfolio from the coming Federal Reserve liquidity shock, you are entirely misreading the macroeconomic data. Okay, let's dive right into this explainer. Look at those flashing Brent crude numbers. The Strait of Hormuz is effectively blockaded. And, just to compound the chaos, the United Arab Emirates just announced an entirely unprecedented exit from OPEC. At the exact same time, the U.S. Federal Reserve is caught in a historic internal crisis. We're talking about a deeply fractured 8-4 split on their latest rate decision. So what's the result of all this? Wall Street consensus is slapping massive targets on gold, pointing straight towards $6,000 an ounce. We are quite literally witnessing a massive macroeconomic collision in real time, and today we're breaking down exactly what the data is telling us. That $6,000 figure? It's not some fringe prediction. It is the consensus among major institutions. The multilateral trading order is unwinding, and it's unwinding fast. Between the energy gridlock and shifting monetary policy in the U.S., institutional capital is rapidly migrating toward non-fiat, hypermobile assets. We're seeing a complete decoupling of gold from real interest rates. Understanding these interconnected forces is absolutely crucial for navigating what comes next. This content is for educational and strategic intelligence purposes only. It is not financial advice. Consult a registered fiduciary before executing trades in commodities, equities, or global real estate. All right, let's move right to our first major catalyst, the global energy shock. Right now, we're witnessing an unprecedented supply disruption in the Middle East that is completely altering the global energy architecture. A U.S. naval blockade in the Strait of Hormuz actually pushed intraday Brent crude oil to an astonishing $126 a barrel. This isn't just some localized geopolitical issue. It's rippling out globally, pushing national gasoline averages in the U.S. to a 4-year high of $4.30 a gallon. Just to put that into perspective for a second, 20% of all global oil trade typically transits through that exact strait. And right now, traffic has been reduced to a mere trickle. According to the IEA oil market report, this represents the single largest oil supply disruption in history. We're looking at roughly 13 million barrels per day totally disrupted. And, well, just when you think the supply side couldn't possibly get more complex, the United Arab Emirates announced a shocking exit from OPEC, effective May 1st. They're targeting 5 million barrels per day of production capacity by 2027, officially breaking away from the cartel's quota system. This is a real game changer. It deals a structural blow to the Saudi-led cartel and adds a massive wild card to an already hyper-volatile energy market. Which brings us to part 2, the Federal Reserve fracture. So let's pivot away from the Middle East energy shock and look at the United States. How exactly are these massive inflationary pressures impacting the central bank? Well, at their late April 2026 meeting, the FOMC voted to hold rates at 3.50 to 3.75%. But the real story here, it's in the dissent. This is a historic 8-4 split. You have 3 hawkish dissenters outright objecting to the inclusion of any easing bias in the language, and on the other side, 1 dovish dissenter demanding an immediate rate cut. Guys, this is the most divided vote we've seen since 1992. The committee is at a genuine crossroads right now, as energy input costs push inflation back up, which is completely eliminating the predictable forward guidance that equity markets have relied on for so long. This complete paralysis naturally brings us to our next crucial factor, the coming liquidity drain. With Jerome Powell's term as chair ending, the incoming chair, Kevin Warsh, represents a radical departure in monetary policy. While Powell leaned toward a balance sheet status quo, what some analysts affectionately call stealth quantitative easing, by reinvesting in short-term T-bills, Kevin Warsh has a confirmed agenda to aggressively shrink the Fed's $6.7 trillion balance sheet. Warsh explicitly views this massive footprint as completely unhelpful for fighting inflation. If he shifts from a passive runoff to active asset sales, it acts as a massive synthetic rate hike on the long end of the yield curve. That's going to drain systemic liquidity regardless of what happens to the overnight rate. The Fed is about to pull the plug on the exact liquidity keeping this market afloat. If you want to survive this rotation, hit subscribe right now to get our weekly macro survival blueprints. All right, section 4, the Gold Supercycle. So where on earth is the smart institutional money going as all this liquidity drains out of the system? Well, it's flowing directly into gold. And Wall Street's biggest banks are completely aligned on these massive targets for 2026. Bank of America sees $6,000. UBS points to $6,200, and JP Morgan, They have a target of $6,300 per ounce, specifically projecting a staggering 800 tons of central bank buying this year alone. I mean, that is massive. They clearly recognize that gold is no longer just some cyclical inflation hedge. It is actively reestablishing itself as a primary, strategic, Tier 1 reserve asset. But what's really driving this absolutely inelastic demand? Basically, it's like a giant puzzle with three massive macroeconomic pieces. First up, sovereign de-dollarization. The weaponization the US dollar through tariffs and sanctions has basically catalyzed unprecedented, price-inelastic accumulation of gold by non-G7 central banks who are just desperately seeking to bypass dollar hegemony. Second is the explicit threat of the Warsh liquidity drain and quantitative tightening, which is essentially forcing emerging markets and corporate treasuries to source non-fiat collateral. And third, decentralized finance. Crypto platforms like Tether are actively expanding their physical vaulting operations, merging crypto mobility with tangible gold security. This creates a massive new demand vector that completely bypasses traditional paper market price suppression mechanisms. It's wild. Finally, let's get into Section 5, the zero-friction playbook. As global markets structurally fragment, you have to understand that modern luxury isn't about massive, static estates and legacy cities anymore. It's all about total jurisdictional mobility. The global elite are fully adopting this dip-in, dip-out living to minimize their global tax exposure. They're using 90-day residency models to avoid establishing a tax domicile anywhere. They're buying up fully managed, turnkey branded residences, and they're migrating capital into tax-free wealth hubs like Dubai, Monaco, and Florida. It's all about zero-friction living, meaning immediate occupation and divestment capability without all the operational drag of traditional asset management. The ultimate safe haven isn't just a tech stock, it's the zero-friction lifestyle. The elites are hoarding physical gold and base hopping across tax-free jurisdictions like Dubai and Monaco to escape the system. That is your blueprint. Click the video on screen to see the exact 3 tax havens seeing the largest capital inflows right now. Don't get left holding the bag.